Welcome, and you're watching Stony Love. And I would like to say thank you so much, everyone, for tuning in. Third time's the charm. Still having some technical difficulties, but I'm not going to fool with it. We have with us JB Burnett of Apex Retirement Solution LLC. How are you this morning?
Great, great. Thank you so much for having me. I'm excited to be here. Thank you.
Oh, yes. I am so excited to have you
All right.
as well. When I say that it is indeed a great pleasure. You are the man of the year. And the title of my title of the show is Insurance and Why Do We Need It?
Okay. All right. Well, that's a open-ended question right there. Um, it'll take a little while to really look at people from an individual perspective, but on a general perspective, the reason why everyone needs to have insurance is if they have any type of belief that they supposed to generate wealth and pass on wealth to the next generations. Insurance is the number one way of being able to do that. But the thing about insurance is that that word, it conjures up a different thought in different people's mindsets. And most people think of insurance as just something that they get when, they pass on when they die. But insurance is something that is more dynamic. It's not static in the sense that you can only use it when you die. And typically there is insurance products as that's the way they work. uh, you don't get to use it until somebody dies. But the types of there's different types of insurance. And I like to look at what people are looking for and to keep everything simple, so that they can understand that if they want to use insurance for the purpose that we're talking about when you die, that's one thing. But if you want to use insurance while you're still living, well, that's a whole different avenue that we can talk about, because there's ways that you can utilize insurance when you're still living in the form of using it, maybe to help your business. You can use it to, for insurance purposes. I mean, for retirement purposes. And
Mhm.
so a lot of people don't realize that, but you can actually utilize insurance while you're still living and be able to help generate generational wealth while you're still alive.
Mm. I know that my mother, God rest her soul, she always talked about life insurance being very important. And I didn't understand that until she died in 2015. She didn't have a large amount of a policy, but it was enough to put her in the ground.
Mm,
And it was four of us left at the time because right before she died, my brother died
mm.
120 days before she passed away.
Oh my.
So it was four of us to split 30, I think it was $30,000.
Mm,
So I think it was, yeah, 30 or $40,000, something like that. But she was put away, and it was like I understood the importance of that. So
mm.
if every month I make sure I pay 77.50 to True Stage.
Yeah, yeah,
If I don't do anything else, I make sure that 77.50
yeah,
is paid, and I have four children.
yeah.
So I have a term life, and
Mm-hmm.
I used to have a whole life when I worked in corporate America. But, as things change in your life, those things kind of diminish,
Right.
and you kind of, lose certain things along the way. What do you recommend when people lose things like myself?
Mm-hmm.
And I'm still fairly young. I'm 53,
Mm-hmm.
but you need something more than a term life. What is the difference? Explain to people what's the difference between a term life and a whole life.
Okay, yeah. Term life is a it's temporary, and you can think of it as renting, versus owning. And so with term life, you're actually renting insurance because you only keep it for a specific term, whether it's 10, 15, 20, 30 years. But once that term ends, so does your insurance. And oftentimes they'll give you an option to go beyond the term, but oftentimes that option is more than you can afford because the cost of the premium can double, triple, quadruple, and so it's not worth keeping because it's you're priced out of it, out of the market for it. Now, permanent insurance like whole life, for example, it's to, like whole life says, it's to cover your whole life. And not only that, but it also has a cash value structure to it where you can actually build cash value while it's also protecting your life. And
Mhm.
so oftentimes people, you've probably heard the term, where you um uh term, buy term and invest the difference, that type of thing. Buy term and invest the difference was something that came along back in like the that a lot of people grabbed hold of. And so term life was the biggest thing, and most people, buying term because it was very cheap, and then taking the rest of their money and putting it into some type of investment. And well, unfortunately, a lot of people don't know where to put the money for investments. So they wound up buying term and that was it. Okay. Now, there's different types of permanent insurance. Whole life is one of those. And a lot of people, talk against buying whole life because they claim that, well, even though you're putting cash value, they're only paying you a minimum guarantee amount, maybe 2 to 4%, which you could probably take your money and put it in some investment and get more, which is probably true. And so here comes another type of insurance called uh, um, universal life. And so
Mhm.
universal life is a type of permanent insurance that allows you to grow cash value, but it also gives you an opportunity and more flexibility on how you use the insurance as well, because you may not have a structured premium that you pay. Like you might have a premium amount of, say, it's a premium amount of 50 or $100. Well, with a universal life, you might have flexibility based on your cash value growing over the years. And if you can't make a payment one month, so be it. They can take it out of your cash value. So it gives you a lot more flexibility because of that. Now, a twist to the universal life is something called index universal life, which is one of my specialty areas because this is an area where you can actually take advantage of the markets,
Mhm.
because not only it's a life insurance policy, so it does have a death benefit, but it also takes a portion of that cash of the premium that you're putting in the that you're paying into the policy. It takes a portion of that cash and puts it into index. Now, index people have heard about in the markets, which is S&P 500 is one of those indexes that's more popular. It's the top 500 companies in the US. And so when you take a portion of that money and you put it in the index, it doesn't actually go into the market, but it goes into the insurance company's general fund, and the insurance company takes that money and they put it into options. And so when the if the options go up, they make money. If the options go down, they don't lose any money. Okay.
Mhm.
Indexing is a way to really grow your money uh, based on the market growth. But when if the markets go down, you do not lose any money. And so that's where indexing come in. It's like a win-win because you can take advantage of the growth in the market, but if there's any losses in the market, your money stays flat. It's like it's like a net, safety net. And so this is a way where you can grow your cash value without any risk and still have the flexibility of having insurance on the side, to cover any of your death benefit issues. So I hope that that helps. I hope it didn't confuse you too much. But those are the different types of insurances that you have access to. The term life is a uh, that's renting your insurance, and it's temporary. And the term life is temporary, and permanent insurance is just that, permanent, and it has cash value that you can use while you're still alive.
So, like, say with term life, there are no medical questions, and it goes in effect right away. There are no. Some insurance policies have like a 2 year waiting period,
Yeah.
especially like on the whole life. Correct?
Yeah. That's the final expense on the most part, because final expense is normally geared towards people in their latter days, and so they have it where you can go through underwriting, and you don't have to have a waiting period if you're fairly healthy. But if
Mm-hmm.
you got some issues going on in your body, they do have a guarantee issue insurance that they can give you to make sure have some kind of coverage when that time comes. But they do limit those guarantee issues, have a 2-year limit to them, so that if you're putting money into them over that 2-year period and
Mm-hmm.
you were to die after that 2 year, you get the face value of the insurance policy. However, if you were to die before that 2-year period, you're going to get back your return of it's going to be a return of premium. Basically, you're going to get back what you put into it. And so
Right.
my father, um, he passed away from cancer,
Mm-hmm.
but maybe it was a couple years before that. Um, he actually uh had we had gotten him some insurance. Somebody, some my mother, I think, had informed me about his situation, that he didn't have insurance. I didn't realize it. So uh I went ahead and got him a policy, a final expense policy, and it
Mm-hmm.
had these conditions on it, about the 2 years. And so, with sometimes insurance companies will try and dispute certain claims. So that's another thing that you really have to watch out for, because all insurance companies are not the same. Okay.
Right.
So in my father's case, he passed away from cancer. And so with his policy, they were trying to claim that that he knew he had cancer before he got the policy, before he got the insurance, which he didn't. He
Right.
didn't know he had it, and so there's a bit of a dispute. And they started looking at the timetable on how long he had it, and he had just had it just over the 2-year period. Okay.
Mm.
And so they were trying to, hold back the claim, because they were saying that he had insurance. I mean, he had the cancer beforehand, and he knew it, but they didn't have any type of documentation to prove that. So the bottom
So
line,
if you have pre-existing conditions before you apply for a policy, it's going to be harder to get a payout on that claim. Is that what you're saying?
yeah, that's where they can put this guarantee issue, this 2-year guarantee issue. That's where that comes into play. So you can, if you got cancer, and when you go through the underwriting and they look at, the condition that you're in, that guarantee issue is going to put you in the box where you have to have insurance for at least 2 years, or you don't get the face value. And so in my father's case, he had just gotten over that 2-year period, so to get the full face value. But the insurance company was trying to make a claim, regarding the cancer situation. They was trying to dispute the whole policy because of that. So no, you can actually still get insurance if you got cancer, but it just adds different type of stipulations to the policy, and those stipulations weren't included in his policy because of him not claiming to have cancer. And so they tried to throw the whole policy out because of that. So, but yeah, the 2 year stipulation regarding uh, final expense though definitely is something that people have to consider if they do have some type of bad health situation, but they can still get coverage. It's just that if they're not expected to live within 2 years, it's probably best for them to just self-fund and put that money aside, to cover the expenses themselves instead of putting it in an insurance company for them to hold the money.
So when you say self fund, would you are you recommending like a pre-need, like pre-arrangement, maybe something like that, or final expense personal account that you've
yeah,
already created?
yeah, that would be just putting in your own savings account or putting in some kind of account that you're setting aside to cover, but self-funding is where you are actually controlling the funds instead of you putting it into an insurance company to control the funds. So if someone's going to pass away within a 2-year period, uh, yeah, it's probably best to just now. If you don't trust yourself, maybe it's better to still go ahead and open up a policy to put the money into the policy. But the bottom line is you're going to get back what you put in. So that's the main thing that you have to understand in that situation.
Now, Apex Retirement, do you sell also, or do you offer um, accidental insurance to you, the consumer?
No, I don't do any type of casualty type of insurance. I just do healthcare, Medicare, retirement planning, and on the retirement planning side, I utilize IULs and annuities to help people to be able to get a lifetime income, so that they can supplement their retirement, maybe supplement their Social Security. If they have a pension, they can help supplement the pension. If they don't have the pension,
What
and
does that mean? Could you explain that?
yes, so annuities, a lot of people don't realize your Social Security is an annuity.
Okay.
And so annuity is basically where you put money into an instrument and then you get paid for the rest of your life from that policy. Okay. And so that's what Social Security is. As you're working, you got a portion of your money going into Social Security all those years while you're working.
Correct.
So that's the way annuity works. So you can take a portion of your money and put also into an annuity while you also, they're taking the money out of your pay while you're working to pay into your Social Security. And then when it's time for you to retire, not only do you have a Social Security pension, but you have a self-funded annuity pension as well. And so when the time comes, you may be getting $2,000 from Social Security and then another $1,500 from your annuity. And so now you're supplementing your Social Security with another pension through what you did with the annuity. And
Can
so
someone who is 1099 set up an annuity with your company?
absolutely, absolutely. Anybody can set up an annuity. And so people can also sometimes people move from one job to another job and they have 401ks, 403bs, whatever retirement money that they were building while they were working. And so that money might be sitting with that company. And I never recommend somebody keep their money with a company that they're no longer with, okay, because they have no control over it. And so I give them the option of rolling the 401k over into an annuity because now they got more control over it and they can
Mhm.
also create a lifetime income from that money as well. So they can roll it over without it affecting their taxes, allow it to continue to grow tax deferred, and then when it's time to take the money out of the account, they can receive lifetime income payments that can supplement their Social Security.
Wow. Now, when do you suggest someone start to invest in an annuity? Is there a certain time or?
No, there's no certain time, but typically annuities they do have a lot of restrictions to them. And so I would recommend, you know, someone who's getting closer to retirement, someone in their a lot of annuities they have restrictions on who can also open up annuity, and probably the lowest age I've seen is about 40. Okay, so from 40 on up, but because of the restrictions, you know, that's the reason, because they do allow you to be able to take 10% out at you know, without any type of fees. A lot of them allow you to take up to 10% of your money out if you have some kind of emergency situation.
So
But
someone my age is too late for me?
no, of course not.
Oh,
So yeah, so with an annuity, you can put a lump sum into it, or you can also get flexible annuities where you put in a regular amount into it as well. But again, because of the different restrictions on annuities, that is money that you want to be able to put aside that you know you're not going to be touching. If you think you're going to be having to put the money in and then pull it out, well, you might want to put it into a savings account or a mutual fund, or not a mutual fund, but a money market account or something like that, where you have more freedom to take money, you know, out of the account. But annuity is for long-term thinking. Okay, it's long-term planning because it's based on you building up your retirement. Okay, so you know there's a lot of restrictions when it comes to 401ks on how old you have to be to take out the money before they start penalizing you. And so if you're under the age of 50 uh 50 uh 50 55,
okay.
yeah, they can penalize you up to 10% if you take the
Ooh,
money out before you're 55.
yikes.
So yeah. And so after you're 55, however, that's where you can take it out without penalty. However, if it's a 401k, most times you have not paid taxes on that money. So not only are they going to take not only are they going to penalize you 10% if you're under 55, but they're also going to tax you as well. So 401ks, money has never been taxed, so you're going to get taxed regardless. Okay.
Okay.
But it's just a matter of, you know, being strategic when you take it out. And so they have something called a required minimum distribution, RMD.
Mm-hmm.
So with RMDs, you have to take the money out of your 401k account or your retirement account by the time you're 72 and a half. Now it's up to 73.
Oh,
So if you don't take it out by the time you're 73, they're going to penalize you 25% of what you should have been taking out. It used to be 50% and they dropped it down to 25%, but that's still a lot of money.
that is, yeah.
You got to take your money. So Uncle Sam, he's designed this system to make sure that he gets his portion of it, because money that's in a 401k in a retirement account is never,
Mhm.
you never pay taxes on it, but it all does not belong to you. Okay, a portion of that money is going to belong to Uncle Sam. And so he doesn't get his money until you take your money out of it. Okay.
Mm.
And so, based on that understanding, there's two different types of accounts: qualified accounts, which you've never paid taxes on it, like your 401ks, or non-qualified accounts, which is money after taxes, like a Roth. You heard of a Roth
That's
before?
the IRA.
IRA Roth. Yeah.
Yes, I have one of those.
You have a Roth account?
Yeah, I
So
do.
a Roth account is good in the sense that all that money belongs to you, because it's money after taxes that you put into the Roth account. And
Yeah.
so it'll grow tax deferred. And when you take the money out, it all belongs to you. You don't have to pay taxes on it.
Yeah,
Okay.
I add to it monthly. So
Okay.
yeah,
Good
I'm
for
with
you.
Navy Federal, so
Good for
I
you.
I put money into that. That was the only way I knew to be able to
That's
uh,
good.
put
That's
something
good.
away for myself.
Yes, and it is the tax advantages that it gives you is you know, the best part of it, because a lot of people they have traditional IRA accounts which means this is money going into those accounts before they pay taxes on it. So even though they grow the money, I think of it I think of it like seeds. Okay,
Mhm.
you put small amounts of money into it over the years. That's your seed, right?
Yeah.
And then after so many years, that those seeds grow into a harvest. Yeah.
Yes.
Now, if you've never paid taxes on that money that has grown into a harvest, and now you're going to pay taxes, well, the question is, would you want to pay taxes on the seed money, the small amounts, or do you want to pay taxes on the harvest, which is the big amount of money that you have left? You want to pay taxes on the small amounts, right? It's
Yeah.
less money that you're paying for taxes.
Right.
Okay. And so what a lot of people wind up doing is, they wind up paying the taxes on the harvest. That's what Uncle Sam wants you to do. He wants you to grow your retirement as big as possible because he gets a bigger harvest from it as well.
Wow.
But the Roth account, like what you have, see, you're paying your taxes on the seeds. So
Yeah.
when your seed money go into the Roth account, you've already paid your taxes.
Right.
And so when those seeds grow into a harvest, because you've already paid your taxes, now that harvest all belongs to you.
Yes.
Now, isn't that smart?
That is smart. When I
That's what
found that
you've
out,
done. Yeah,
I
that's
was
what
like,
you've done without even realizing it.
yes. So yeah, I thought that was the best way. Since I work for myself independently, I'm an independent contractor. I do side gigs. Um, Content is my main thing is what I'm driving towards. So I don't really make an income from
Mhm,
it. I
mhm.
used to during the pandemic. I was at a level where I was making through sponsorship, and I'm aiming to get back there next year.
Okay.
So IRA and my bank account is like that was a way for me to just slide money in,
Mhm,
$20 there, $30, $40, and it just adds up.
mhm, mhm.
Just to have, because I'm getting older.
Right,
So
right.
I wanted to have something for myself, and then I have the term life with True Stage. I think it's till I'm 80. I plan on living past that, so that's gonna be a problem.
Yeah, yeah.
Because I'm in good health.
Mhm.
But it was affordable because remember I told you the things that I had happen with my whole life with Aflac. I was working through corporate America, so I lost some things along the way. But
Okay.
I knew I needed something in case something happened, and I have 4 children.
Mm.
So you try to juggle, and you don't want to leave the kids without nothing.
Mm-mm. Mm-mm.
And I'm Stony Love. I don't want my kids on Facebook talking about, hey, can you can y'all give my mama some money?
Yeah.
So no, we don't want that. So I make sure I pay that money comes out of my account every month, and
You.
I know how important that is. Another big thing that I want to talk to you about while we have a little time,
Mhm,
health insurance. This
mhm.
is a big thing on Capitol Hill,
Oh, yeah.
and and you are someone who help people with health insurance.
Yeah.
2026, what is it going to be like for Americans who need health insurance? What is it looking like for the subsidies for, we'll say, an average American who makes $40,000 a year? 4 kids, maybe. We're just going to use that number.
Yeah. Well, that honestly, you need a crystal ball to answer that question because it really the fate of Americans is in the hands of Congress right now when it comes to subsidies.
Mm.
Okay, because even though right now, as yesterday was the end of the first part of open enrollment for people under 65, and so this we're coming up. Um, so during that time, while I was helping people during this open enrollment period, they were giving us the ability to they was offering the subsidies. And so,
Really?
Yeah, yeah. So everybody that I was able to help with their health insurance under 65, or who weren't getting it through their jobs, uh, they were still offering the subsidies. And so, of course, we're looking at their costs of their premiums based on those subsidies. And so, some of those insurance, however, they may be about $1,000 a month. Okay. But with the subsidies, some people are paying zero, or they may be getting maybe $1,200 in subsidies. So that covers the full amount of the insurance. So they don't have to pay anything. It's zero. Some people, maybe they're only getting maybe about $800 in subsidies, so they might have to pay, about $200 for the insurance. But the bottom line is that the subsidies makes the insurance affordable.
Yes.
Without those subsidies, nobody can afford to pay that $1,000. Somebody like you say, $40,000 a year. Now they got to pay $1,000 a month for
Right.
their health insurance.
Because if they don't approve those subsidies, it's looking like that will go up 114%, which is about $1,000 a month, and that's 2 million Americans without health insurance. Is that correct?
Yes, yes. And unfortunately, a lot of these people, they're gonna have to utilize, you know, emergency rooms if it gets bad enough where they gotta get some kind of health coverage. They gotta go to emergency rooms, so which is not a viable, health care, the emergency rooms. However, emergency rooms can't turn nobody away. Okay. And so, if you don't have any kind of coverage and you got some illness going on and you don't have coverage, you're going to go to the emergency room or urgent care. And so,
Right.
what you'll wind up finding is very packed, emergency rooms, and with sick people in it, sitting around waiting to be seen, and that is no way to operate. And unfortunately, people are not going to have any choice. However, so I do have some alternatives,
Okay.
that I'm able to offer people, and through different alternative markets other than the marketplace, because it's the marketplace where they get the subsidies from, through the government. But outside of the marketplace, onto the private networks, there are some avenues where, if people become like a member of a organization, they can be like an employee getting group rates.
Really?
Yes, yes. And there's 10 people, 1099 type of people also can get group rates. If they like, the trick to some of these group rate type of companies is that you have to fill out a survey. Okay,
Oh,
maybe
that's nothing.
exactly. That's basically giving you the ability to get these group discount rates. Just filling out a survey, maybe twice a year or something. Okay.
Oh,
So these
nice.
are different. These are different options that I'm helping people with outside of the marketplace, where they can get affordable coverage. And I just helped a couple last night. They got like, it's like 8 of them. The the mother, father, and 6 kids. That's
Wow.
8 of them. Now they're through the marketplace. That insurance for them was going to cost them $4,000 a month. And see, what's happening is that last year that same insurance was only $2,000 a month, and I'm talking about without the subsidies. So it's about $2,000 a month in 2025. Next year is going up to $4,000 a month, and their subsidies is maybe increasing by about $600, going from like maybe 2,300 to 2,900 in subsidies.
That is insane.
So the bottom line is they're still having to pay out, pocket about $1,500 plus up to maybe $2,000 it was, in subsidy. I mean, out of pocket, and so they can't afford
So
that.
with the group, how much would their copay be? Would you say, for an example?
So the copays with this group insurance that I'm telling you about, and it's not a group rate. I mean, it's a group rate, but it's not group insurance. It's a group rate, however. And so the copays are $20, $15 to see your your primary care doctor,
Okay.
$15 to see a specialist, 100% for your preventative type of
Here, yes.
appointments. Yep. And so
And do you
it's
offer dental? Is dental offered with that? And what
dental is
about eye
always
care?
no dental and vision is always separate. Those
Okay.
are standalone type of coverages that you can get, but they're still available at very affordable costs. It's the medical that you really got to find, the thing that is going out the roof. And so, but with this plan, I was able to get this couple. I think they had three different options. One was about $348. One was $358, and one was like $492. And so these were hospital indemnity plans, which would give you the copays, and it also gave you hospital indemnity, which means they pay you if you go into the hospital. Okay,
Is that
so
something like Aflac?
yeah, that's something like Aflac, where they pay
Okay.
you and when you go in the hospital, but they had different levels to these plans. But the point is, it gave them the ability to still go see the doctor, and they could afford it, and it applied to their whole family as well.
For $300 a month.
It was, well, 300 was the minimum. It was 358 was the minimum, and 492 was the upper. So it was
The upper tier.
bronze, silver, and gold. And so they decided
So
to go to the
so
high.
say for someone like myself, if it was a singular, how much would something like that cost a person like myself?
For an individual, I think it was from $135 on the low end,
Mm-hmm.
and about 200 and something dollars on the high end,
Bad.
which again is much more affordable than
The
six
marketplace.
$1,000 a month, yeah, than the marketplace without subsidies, yeah. And so these are alternatives that I've been able to help people with, and see right now, even the people that apply for the marketplace and they're showing they're getting subsidies. Well, if Congress doesn't come through and extend those subsidies, unfortunately, their bill is going to change
Mm.
drastically. Okay, and
So
so
although you were able to enroll them under the subsidies, and if Congress doesn't reach an agreement or some middle point, then they're going to get a bill and say, hey, yeah, you're with Aetna for $0,
yeah,
but come February the 1st, it's going to be $900.
yeah, because there's no
Oh,
subsidy.
no.
So, and see what's happening is these insurance companies is raising their premium by so much, because like from last year, is or this year 2025, their premiums without the subsidies was at one point, but now when you look at the 2026 premiums, you see where it's jumping up to like the percentages that they're jumping up is just astronomical. These insurance companies are basically making people cross the coals, because they're expecting the government to pay the subsidies to help people out. So, but if the subsidies don't come through, everybody's on their own, and they have to pay the regular cost of the insurance without subsidies, which is going to be very hard for many people to afford that. So everybody's watching Congress. What are they going to do? And so far, they haven't been able to do anything. So,
Wow.
yeah,
That is, I pray that Congress is able to come to some median, and that they're able to work together.
I agree.
And it's
I
it's been
agree.
a whirlwind. I pray that we do not have another government shutdown anytime soon.
Yeah.
And it has been a great pleasure, speaking with you this morning, in spite of all of my technical difficulties that cause me so much anxiety.
Thank you. Thank you for
Tell
having me.
everybody where they can find you and how we can keep in touch with you and get some of these great deals that you offer because people need health insurance. You have broke it down to us
Absolutely.
why we need health and life insurance.
Absolutely. Well, you can go to my website, which is Apex Solutions, Apex Retirement SOL.com.
Okay.
Apex Retirement SOL.com is my website. And also, when you go there, you can request a copy of my book. It's called Starting Medicare Smartly. And I'll send that out to you complimentary.
Wow.
People who are just turning 65 and, you know, are trying to figure it all out. You know, my book helps to explain everything in an easy to understand content. And, you know, and if you have any questions, you can also reach out to me and I can walk you through. But
So
that's
where can we find too a copy of your book? Is it on Amazon or Barnes and Noble?
well, actually, I only use it for marketing. I probably should, you know, expand it out there. But right now,
Yeah.
it's a complimentary book, so it's just found on my website for right now.
Okay.
Yep. So go to my website and just request a copy, and we'll get it to you complimentary.
I sure will, but I think you should put it out there.
Yeah, yeah. I think you might be right.
Yes, get
Yep.
that ISBN number and go ahead and put it out there. So even if it's a digital copy, people can download it. And you put the hard work in, get paid for
Yeah.
what you do. You have so much wealth of knowledge, and thank you for sharing that with everyone.
Thank you.
And we're gonna definitely see where this goes.
Yeah.
I'm gonna be back in touch with you after the subsidy thing.
Yeah. Yeah.
I
We'll
gotta have
follow up.
you.
Sure. I look forward to it.
Somebody keeps calling, and it's very rude.
Oh, okay. All right. Okay.
Um, I gotta have you back on to talk about these subsidies,
Yeah,
and we're gonna
absolutely.
see what Congress do. But we're
Okay.
gonna end it here.
All
And
right.
thank you, Barnett, for hopping on.
Thank you, Tony.
Apex Retirement Solutions LLC. Make sure you guys check them out
Yes.
and understand why you need health insurance. Replay this video so you can understand all of the things that Mr. Burnett has to offer and reach out to him
Yes.
and utilize the services that he has.
Absolutely.
Wonderful guy.
Well,
Glad
thank
I
you.
met you.
All right. Likewise. Thank you for having me, Stony. It's been a
Yes, sir.
pleasure. All
Until the
right.
next time. Thank
Thank you.
you. Bye
Bye-bye.
bye. Bye bye.